Understanding when to buy a stock is important, but knowing when to sell is equally critical. Do you sell to lock in a profit or to cut your losses? Here are 4 signs that indicate it's a good time to sell your stock. First up, look at the company's fundamentals. If things like quarterly earnings or performance against its peers are deteriorating, it may be time to unwind your position.
For company-specific reasons, when investors look to sell a stocks, if they were to foresee any fundamental change in the company, that could come in terms of a declining revenue for the company, shrinking margins, poor management decision, or basically the company losing market shares to its competitors or failing to adapt to any shifting industry dynamics.
One example is Intel. The chip maker was once a leader in the chip space, but it's currently navigating a period of significant challenges, including increased competition and market share losses. The chip maker's costly turnaround has also hurt its profitability. And in December 2024, the company's CEO was forced out.
Intel has struggled to keep up with its competitors in the semiconductor space, particularly in AI-related technologies. Another example could be in terms of Walgreens Boots Alliance, which is a retail pharmacy chain in the US, which has also been facing mounting challenges from online retailers and the changing consumer dynamics. Last but not least, we also have the legacy media companies, such as your Warner Bros. Discovery, your Paramount Global, which has also struggled to adapt to the changing landscape from traditional media to the streaming industry.
For income investors, Intel's shrinking dividend payouts isn't good news either. In August 2024, the chipmaker said it was pausing dividend payouts. Another warning sign could be a company's payout ratio. This is the proportion of earnings paid out as dividends. If a company's payout ratio exceeds 100%, this means that a company may dip into its cash reserves to maintain dividends. Or it could reduce payouts. A healthy range is usually between 40% and 60%.
If the company were to issue a negative profit guidance, or if the company were to reduce its dividends without delivering much of a growth story, that could also be a signal for investors to sell the stock, especially for dividend investors.
If a company is reporting negative free cash flow, this could be another red flag. Negative cash flow means a business is spending more money than it earns. Telltale signs include falling profits, a heavy reliance on debt, or a sharp increase in capital expenditures to maintain the business. For those who are only buying stocks to trade for the short term, there's a technical signal that tells you when to sell.
So usually price target may be determined by chart patterns or key resistance levels or various technical indicators such as your Fibonacci retracement.
That's referring to price levels that indicate where support or resistance is likely to occur. The support level is where the price regularly stops falling and bounces back up, while the resistance level is where the price normally stops rising and dips back down.
So for example, once again, if you were to buy a stock at $1, you may set a stop loss level at probably 95 cents. So when the stock price were to decline to 95 cents, that is where you acknowledge that your views may not be right this time round, and it is wise to sell the stocks to limit further losses. So usually the rule of thumb is that the stop loss should be set 3 to 5% below the entry price.
Once you've decided on your buying and selling price, you can calculate your risk-reward ratio.
I think the catch here is that when you are going into a trade, the potential reward should always far outweigh the risk that you are putting on the table. So if you are buying a stock at $1, price target at 120, stop loss at 95 cents, what this means is that you are actually risking 5 cents to reap a potential reward of 20 cents from this trade. So this is a 1:4 risk-reward ratio, which is favorable and suggests that you should always go for this trade.
Setting a take profit or stop loss level on your trade lets your brokerage know at what price you'd like to sell your shares.
So for example, if you were to buy a stock at $1, you can set a price target at around 120, for example. So when the share price were to move up to 120, that is where you will sell the stock no matter what, and to lock in that profit.
Another common reason to sell a stock is to adjust your portfolio. For example, if you notice an over-concentration of capital in one sector, diversifying your portfolio can help reduce risk.
If the investors were to have a single stock in his portfolio that far outperform the other stocks in his portfolio, such that it constitutes more than 60% of his portfolio, it will make sense for him to pare down his exposure potentially down to 20%, so as to limit the concentration risk for his portfolio as a whole. Of course, the counter argument here is that we should always hold on to the winners and to let it run. That is not wrong, but for risk-averse investors, it will make sense for them to limit each counter exposure to potentially around 20%, so as to reduce having their portfolio being overexposed to a single counter.
Sometimes the grass may actually be greener on the other side. When deciding whether to sell a stock, consider whether you are able to reap better returns elsewhere. For example, within the stock market, you may want to rotate your capital between sectors to maximize returns.
In a risk-on environment where we are looking at very strong economic momentum, it will make sense for investors to sell stocks in the defensive sector, such as the healthcare, utilities, and consumer staples, and to rotate this capital into other risk sectors, such as technology, consumer discretionary, which tends to perform better during times of economic boom.
You could also rotate capital across different capital markets.
Investors, if they were to foresee a continued economic slowdown in certain markets, for example, in China, they may choose to sell some of its Chinese holdings and to rotate this capital into stronger markets, which tends to see a picked up in economic growth, such as Japan or India, for example.
Sometimes when one asset class is underperforming, shift your capital to another asset class to get better returns.
So for example, back in October 2023, when government bond yields are relatively high, investors may choose to sell some of his stock holdings and to rotate this capital to lock in the relatively high yield in the fixed income space.
There's no one-size-fits-all strategy for selling a stock. Sometimes life events such as buying a house or even meeting short-term financial obligations could be reasons to sell your shares. Whatever may be the case, work out your risk tolerance, available funds, and plan ahead to meet your financial goals.